applies to tech. So what I want to do is just give you a really good primer in the next 30, 40 minutes and then open it up for question and answer. And again, always open for a follow-up if you guys want to reach out to me. So what we're going to cover, back one more, sorry. I'm quickly going to cover the stages of venture financing, just so you know when to raise money at what stage. I'm going to talk a little bit about the story that you need to be able to tell to raise outside capital, the tools that are used to do it, the targets, the people that you should be approaching, either angels or venture capital, and how you determine who your targets are. And then I'll give you some tips. Is that good? Does that meet your expectations? Awesome. All right. Let's thank you for that. That's good. All right. So this is the stages of venture financing. You got the stage. You've got roughly the amount of money that's raised, the source of it, and the structure of the deal. So the idea stage, and this is where a lot of entrepreneurs get off to the wrong start. The idea stage, to develop a prototype, maybe you have a little intellectual property. You got a website, you've got a domain name, maybe you have a trademark, maybe you filed a patent. It's still the idea stage. Angels and VCs don't look at ideas. So that's one of the misnomers about raising venture capital. Unless you have exited and had a huge exit, and then you can call up some buddies in the VC world and say, I'm thinking about doing my next deal. They may talk to you. But no sophisticated equity investors invest at the idea stage. That's called friends and family financing. Some people call that FFF, friends, family, and fools financing. But that's the stage where you got to raise the money. Typically, what's raised at that stage is between $5,000 and $100,000. So that's about the sweet spot for friends and family. From there, you move up to the seed round. And in my experience, there's usually 2 seed rounds. It's another misnomer about raising capital. It's very common to do 2 seed rounds, not just one. The first one, once you have your MVP, that stands for minimal viable product. Everybody knows what that is, right? So seed stage to get an MVP, and also to get product market fit. That is typically in the 100 to 500,000 range. I invest a lot there personally. My friends invest a lot there as angel investors in that sweet spot. How those deals are structured is typically done as a convertible note. So you don't have to have the argument with a angel investor like myself or VCs about what's my valuation and what percentage of the company you're going to take for the money you're going to give me. Typically like to kick that can down the road at this stage. At the first seed stage, the conversation is typically around a convertible note that converts later based upon certain milestones. Everybody get that concept? Very important. Okay, and so if you successfully make it through that stage, you come up to typically seed stage 2. Sometimes VCs get involved in seed 2, but it's usually angels. That's in the $500,000 to about $3 million range, and the goal there is to get launched. It's typically people that are in the seed 2 stage. They have a growing user base. They may have revenue but not profits, but that's okay. You can raise up to about $3 million in that stage. You can still, at this stage, you're probably still doing notes, but in some cases you start converting to equity at seed 2. This is where the valley of death happens. So I've been involved in a lot of companies that didn't make it. Of the 7 companies I started, 4 did reasonably well, 1 did okay, and 3 crashed and burned. And they crash and burn at what I call the valley of death. It's called the Series A crunch. You can't get to Series A. And we'll talk a little bit more about why and how to overcome the valley of death and get through C2 to get to Series A. But if you do get to Series A, that's usually in the 1 million to 10 million range, 3 million to 10 million. Most VCs, another misnomer, entrepreneurs don't know, they have to put a certain amount of capital to work. So unless you can justify that you need $3 million and you're ready for $3 million, they don't want to talk to you. They'll tell you to go talk to angels, source your financing elsewhere. Okay, if you make it through Series A, you get to Series B. By the way, when the company I called, I copyright, we went up to Series E. I mean, it can keep going. depending upon the amount of money and how the company is tracking. So in a Series B, you're typically raising between 5 and 25 million. It's from VCs. It's going to be preferred equity, preferred stock. Then you can get to Series C, or what's called mezzanine financing, and then finally you hopefully you will have an exit within 5 or 6 years. So I just wanted to give you sort of the landscape of the stage and the different amounts that are raised and the kind of structure that happens at each stage. Okay. Here's the reality of the world. This is by Mattermark, if you want to track venture capital and how deal flow is going and who's raising and who's not raising and what the statistics are. This is a very good chart. Out of the 100% of the companies that raise some level of seed, which like I said is typically, seed's going to be in the $100,000 to $500,000 range, or the seed one is. Out of the companies that raise seed, only 25 to 30% actually reach Series A. So you have this super huge precipitous fall off. And those who reach Series A, it goes down precipitously from there to where when you get to B or C, only about 1 or 2% of the companies are actually going to be able to keep raising money. Next slide. This is also another good source for you called CB Insights. I'm a subscriber. A lot of great data on venture capital and who they're funding and who's raising, what the valuations were. Good source of data. But this is their funnel, and I wanted to make some points here. So 70%, this is the valley of death that I talked about, 70% of the companies that got seed, they die or fail to exit. So they become what we call the living dead, or some of them may just become self-sustainable, but even becoming self-sustainable is hard for an investor because that means you can't get out. I'm in a couple of those deals now, or I've been in some of these deals for 5, 6, 7 years, and I can't get out, and I call myself a stockholder. So I invested $25,000 or $50,000 something. 5, 6 years later, I can't get out. Right? There's no exit, and those are hard deals. So no VC, no angel wants to go into a deal thinking they're going to be a stockholder. They're looking to figure out how the company's going to exit. So here's the other thing you have to understand about VCs. Only 2 in 10 of their investments are going to make money. The rest are going to bomb or break even. So in order for that to pay off for them, they need a 30x return on their money. Think about that. If they are going to give you $1 million, they need $30 million back in order for them to meet their targets with their limited partners. So that's their threshold on how they make investment decisions. Does this company have the potential of delivering me 30x my money? They won't exit for less than 10x. And I had this situation at iCopyright, a company I started. I raised about $30 million for, and we had some great offers. But by those times, the VCs would not let me exit because the return to them would have been less than 10x. It would have been maybe 8x or 9x. That's still pretty good. Most people would say, I would love 8 times my money, right? But they said no. In order for them to make their numbers, they had to get at least 10x. And so there was a couple of times there where could have been doing this session with you from Bali or something, but I couldn't exit because the VCs wouldn't let me. So that's another thing to keep in mind, is they have their own benchmarks and metrics for when they invest in you, whether they'll let you sell or not. Okay? All right, I know this is a very busy slide, so I'm going to just highlight a couple of key points. This is the story that you have to tell if you're going to even get angels or VCs interested in investing in your company or your client's company. So there's 5 parts to the story: product, market, team, strategy, and economics. So with the product, it obviously has to be demonstrable, it has to be working, it has to be at least MVP, and it has to be disruptive or 10x better than what's already on the market. There's another misnomer that entrepreneurs make. They come to market with a product, they're in love with the product, and it's just a little bit cheaper than what's already on the market, or just a little bit better, it has another feature, and that's not enough to raise venture capital. You've got to be exponentially better with your product. Venture capitalists like to say they like to invest in pain pills, not vitamins, right? Vitamins you don't need. They're not a must-have. You know, they're a nice-to-have. Pain pills, people have to have them if they're in a lot of pain. And so they want to see that your product is a must-have, that it solves a real pain point in the marketplace, that it's not a nice-to-have. That's another usual criteria that they look at. It's needed now. There's a competitive advantage. There's some barriers to entry that someone can't take what you have, and that's the thing. I see, by the way, I forgot to mention, I'm still doing investing. I see 1,500 decks a year. That's how many decks I get. A deck is a investment proposal presentation. So by the platforms, I see about 1,500, a lot of decks. And almost none of them have barriers to entry. A competitor down the street can start the same thing and get to where they are in 3-4 months, right? So that's always a red flag. So you have to have some barriers to entry in the deal. And get a good handle on the COGS and margins. So that's how they're gonna, any VC, and by the way, I've got a website URL down there. You can take this test on my site free. It will step you through these questions on each of these 5 dynamics on any deal that you want to put in there, and if you answer it honestly, it will score you, and it will tell you what your likelihood of raising venture capital is. And that's just a free service that I offer on StartUpBiz. On the market, you have to have unique insight. You have to really know that the total addressable market has to be at least 100 million or more. They don't want to invest in markets local, like if you're a local pizza shop and then you're only going to make maybe a couple $1 million a year. They want to see a $100 million opportunity. So your total addressable market has to be fairly large to raise venture capital. If it has some virality and network effects, that's good. And you really understand the 80-20 rule, which is about 80% of your revenue is going to come from 20% of the early adopters, and knowing who they are and how you're going to reach them, attract them, and convert them. Team is next. Team should be working full time, and you have to have a balance of sales, product, which is usually technology, and operations. And operations is usually finance and HR. So I get a lot of decks. People say, if you give me the money, I'll quit my job and start this company. I'm like, no, quit your job, start this company. Get your team, get in the market, and maybe I'll consider investing. No investor is going to invest in a team that isn't working part-time in the deal. They're just not going to do it, right? You have to be there. And having started a bunch of companies and worked in the basement and had mortgages to pay, I know how painful that is and what a tough decision it is. But that's what's required to raise venture capital and to show that you believe in your idea. Breadth and depth of experience, so you really understand the space that you're operating within as a team. Got a good culture, good chemistry among the founders. I've been in rooms, I've been in brainstorming sessions with founders, and they're yelling at each other, they hate each other, they throw things at each other. It's like, I don't know if I want to invest in these guys. So having good culture and good chemistry among the founding team is super important. Having a staffing plan in place, knowing what your gaps are. That's the first thing I'll ask an entrepreneur, what are your gaps? And she'll say, what's a gap? And I'll say, who do you need to hire in the next 6 months, 12 months, 18 months to help you reach the plan? They usually can't tell me. So knowing what your staffing gaps are and have job descriptions ready to go, always helpful. Having some professional advisors, maybe a mentor, always helpful. And have your cap table, your capitalization table, which is your ownership structure, all in a line. I've seen messy cap structures where, yeah, that guy was in our dorm room when we first started it, and we gave him some shares, but I don't remember how many shares we gave him. You've probably heard these things, right? Those are disasters. And I've invested in companies where 2 or 3 years later, once the company got traction, started making money, people started coming out of the woodwork. Like, they promised me some shares because I wrote the marketing plan, or this accountant said, I did the financial projections and they were supposed to give me 100,000 shares. And the company starts getting sued, and you got a mess. So one of the things that venture capital is going to do is going to look really closely at your cap table, your ownership structure, and make sure that it is clean, because they don't want any surprises later. Strategy is all about how you're going to go to market and how you're going to win. Most entrepreneurs are really bad here, and that's okay. If you're good at everything else, you can have a bad strategy because I can fix that. Any good VC that knows what they're doing can fix strategy if the other elements are in place. But having a sense of it and being coachable to let them change your strategy, very important. Okay, I'm not going to spend a lot of time on that. Economics is the last thing. This is where the deal usually falls apart. Again, having raised a lot of venture capital in Silicon Valley, in Seattle, New York, Chicago, really it all comes down to the economics for the venture fund, and where it usually falls apart is in valuation. Entrepreneurs have an overinflated sense of what their idea is worth, or what their company is worth. And that typically kills the deal, because if the investment by the VC doesn't make sense for the amount of ownership they're getting and their ability to follow on and on a pro rata and not get diluted, there's all kinds of things in the term sheet that you have to look at, which save that for a different session. They have to make sure that they can hit that 10x, 20x, 30x. And if they can't, because of negotiating with the entrepreneur on what they expect to give up, I mean, it's not uncommon for entrepreneurs to sit down in front of me and say, I need $10 million and I'll give you 10%. And they have no revenue. Right? I mean, it's just not uncommon. But it's an incredible amount of confidence, I guess, in an idea or a company, but it will never fly. Because there's no way that as a VC, if I invested $10 million and you only got 10% of the company, after additional rounds, I would ever see any of that money back. Right? So the economics have to make sense, not only for the market in terms of the business model and how you're going to attract customers, but the economics have to make sense for the investor. And here's the other important thing about that. Investors don't want to be with you for the rest of your life, right? They want in, they want out. And that's the other thing entrepreneurs have a hard time with is when they'll say, what's your exit strategy? And of course, I'm supposed to say, well, I'm not going to exit. I'm going to run this thing for the rest of my life. That's great. You should run it for the rest of your life. I hope you love it and passionate about it, and this is your baby, but I want out. You know, what's your plan for getting me out in 3 years, 4 years, 5 years? And that discussion has to happen. All right, so we covered a lot. I'm just flying through this. Is that okay? All right. Let's go to the next one. That's the story that has to tell. These are the tools. These are the tools of a trade in raising money. You have to have a good pitch deck. That's the calling card of every entrepreneur. It's usually 10 slides, not 50 slides, not 100 slides, not 12 slides. 10 good slides, mainly covering the 5 things that I just covered. Right? Slide on each one of those and a couple of other finer points. A good pro forma, hopefully a business plan. Some entrepreneurs do them. Some VCs require them, some VCs don't. Some VCs don't even like them. I personally like them because it shows that you can get it out of your head and onto paper. And it becomes an operational blueprint for your company. So I love to see business plans, but definitely have to have a pro forma. You need to be up on the investor platforms. Are you guys familiar with investor platforms? AngelList, Gust, Proseeder. Most investors will only filter and screen investments that come through one of those platforms. So Enrique's here. He did. Which platform did you guys use at New World? You use Gust. So if you were to apply for funding at New World, which Enrique was the screener, to see who screened through that, you'd have to put yourself up on Gust. So always good to just get it up in advance before you even do your first reach out to an angel or a venture capitalist. The metrics. This is the thing I love the most about venture capital, because I'm a metrics guy. If you know your metrics, your odds of raising capital, assuming everything else I just said is true, go way up. Way up. And I can spend an hour on each one of these metrics, but you need to know them like the back of your hand in terms of your company. Your annual recurring revenue, if you don't have it projected, your annual revenue per customer. That's the number one metric. Your monthly recurring revenue, your gross merchandise volume versus your revenue. What is that? So at Copyright, our gross merchandise value might be $10 million a month, and we were taking a million of that because we were delivering 9 million back to our customers because we were an intermediary, right? We're just processing the order for our customers. So gross merchandising value is the total amount of money that runs through your business, but then how much of it do you keep? Gross profit, lifetime value is super important. Everybody will ask you, what's your LTV? What's the lifetime value of a customer? So when I started Sprynet, for example, which went public in 1996, was on the launch team of that, the lifetime value of a Sprynet customer was about $180. And the GAC, the cost to acquire of a customer, was about $30. Right? So we had proof of that all of our marketing and all of our reach out, it costs us about $30 to acquire that customer, but the lifetime value before they churn was about $180. It's pure economics, right? You can make money if you can scale that. Excuse me. The number of downloads and active users, month-over-month growth rate, your churn rate, that's always important. How quickly are customers coming and going? I've got lots of app people, they contact me and go, I got a great app, and I'm getting 1,000 downloads a day. And I say, okay, how many, from the downloads, how many activate the app? Oh, 100. All right, so of the 1,000 downloads, 100 actually activate it. Of the 100, how many are interacting with it daily? 1. Right? So someone's laughing. It's like, yeah, I've been there. I've seen that. I've seen those companies. It's super important to know what the churn rate is, and you have to have a reasonable churn rate, or otherwise investors will know you're great at getting downloads, you're great at getting people to your website, but that doesn't mean anything because you can't convert them. Your churn rate is way too high. And then, of course, your burn rate. VCs love to talk about burn rates. It can cost you a lot in valuation if you knock on a VC's door and you're doing well. This has been me, I've done this. You knock on a VC's door 3 months before you're out of money. They do the calculation. They know what your burn rate is. They know what your burden, what you need to have. Man, it puts you at a real disadvantage if they know you're going to be out of money in 3 months in terms of negotiating a term sheet, right? So we can talk about strategy when that happens, because I do that now. I help companies not only raise money, but I help them get acquired when it's time to exit. So there's a whole strategy about going in with a position of strength as it applies to your burn rate. Okay, that's the tools. Next. The targets. Okay, so the first thing is almost all investors, they specialize in sectors. And so no need to be going to Googling all the venture capitalists that are in the state of Florida and writing them all a letter or going to their website and applying, because they all specialize in different sectors. Life sciences, tech, SaaS, e-commerce, mobile, whatever it is. That's the first thing you have to find out is what sectors are the VCs, or even the angels. Some angels have preferences, angel groups have preferences as well. What is their minimum investment, and what are their ROI expectations? Obviously, if you need to raise a minimum of $5 million, then you need to see what their minimum check will be. And so if their typical check is $3 million, which is typical for a VC, you know you're going to need 2 of them, which it's going to come up into a tip, but that's a really good point. The best thing you can do for yourself in raising money is find a lead investor. Find the right lead investor who will help you raise the rest of the money. Other criteria, geography. Some investors will require you to move. So I had to turn down a lot of money early on when I was raising for iCopyright because I lived in Seattle and I was raising out of Silicon Valley. I ended up raising about $15 million out of Silicon Valley, but a whole bunch of it I had to pass on because they said, you need to move here. And I wasn't going to move to San Francisco. or San Jose, right? So they have geographic preferences. I work with entrepreneurs here. They get a little upset about that. They want me to make introductions to investors in Silicon Valley, which I'm happy to do if I think it's a good deal. But I tell them, you're going to need to move. You have to say goodbye, Florida, because the investors you want me to introduce you to will only invest if you're there. So that can become a key concern. What are their submission requirements? I always say, just make sure you have a good intro. Find somebody who can introduce you. Enrique, for example, is very well connected. Myself, there's some people who just know who the VCs are and the angels are. It's always good to have the intro. They'll at least take a serious look at your deck. And then know what their non-negotiable deal terms are, and that's going to vary widely from angel group to angel group and VC to VC. These are the suspects before they become targets. You have angels, VCs, family offices also invest in early stage companies. There's a lot of family offices in Florida, a lot of wealthy families that have what's called a family office. They're managing their wealth, and they put aside a little bit of their portfolio for early stage companies. So actually a lot of those, and it's usually an overlooked target. Social venture investors, some of them want to make sure, someone will invest in companies if they have a social good, a social component. In Miami, a new one just opened up called Social Venture Partners, SVP, actually started in Seattle. I knew those guys when they first started. In Seattle, they're huge now. They invest hundreds of millions of dollars in companies that have a social component to them. And then there's private equity groups. Those are more designed for mezzanine. Super good tip here. Very few entrepreneurs know this. They never ask the question because they don't know the question to ask. But make sure the funds that you are approaching, assuming they are a good target, assuming you have a good deck, you have a good story, and everything's in line, make sure they have dry powder. I learned this the hard way. What that means is they may be holding themselves out of venture capitalists, but guess what? They've already deployed all of their funds, and they're scurrying around trying to raise a second fund. Well, you don't know that, right? So I spent 6 months with a venture capitalist who kept saying, yeah, we want to do a deal, we're going to do the deal, we love the deal, and I'm waiting for the term sheet, and I'm waiting for the term sheet, and we got to do a little bit more due diligence. And they were just stringing me along, because I found out they had no money. Yeah, they had a $200 million fund, and they had invested it all. And they're scurrying around trying to raise another $200-300 million fund. And they will keep you on the line. They will waste your time. So the first thing you should ask them is, have you deployed all of the money in your fund, or how much of the money in your fund is still available? Ask them that question. They'll go, whew, this is a really smart entrepreneur. They don't want you to know that. So super good tip, though. All right.
They would say it's none of your business.
If they say it's none of your business, then you know the answer. All right, here are some tips. So your opportunity has to be a scalable opportunity, right? It can't be local or even regional. It really has to be a $100 million plus opportunity with a competitive advantage, and you have to have some traction. No angel investment fund, no venture capital group is going to invest without at least those minimum three criteria. So go friends and family, go early seed to get to that stage before you go VC. I always say make sure you're raising for the right stage, and the stages are spark, pilot, and fuel. So think about that. Friends and family, they invest in the spark, right? You've got a spark of an idea. The only way you're going to get money to try to light up that idea is through friends and family. No VC, no angel is going to give you money to spark your idea, right? The spark has to come from friends and family. That's what that's for. Pilot light, angels are great at that. That's get a good steady fire going. It's coming right along. Angels like to invest at that light. VCs only like to fuel growth. They want to throw gasoline on your fire, right? They want to take you from 1 million users or $1 million to $100 million, right? So they only want to fuel growth. They don't want to invest in your spark, and they don't want to invest in your flame, in your pilot. Super good to know what their mindset is. Know your market, know your numbers, hit your projections. VCs love to talk to you about your numbers, and you need to know your market, and you need to know your numbers inside and out. Do not show them hockey stick projections. That's the first sign of an amateur entrepreneur, first-time entrepreneur. You come in, we're doing this, and then year 3 we do that, right? So we see them all the time, and we immediately throw them out because that's just not the way most businesses grow. Focus on securing a lead investor. Always was important to me when I first raised money for iCopyright. My first investor was Guy Kawasaki in Silicon Valley. He was with Garage.com. He's a well-known evangelist. He came out of Apple. Bunch of best-selling books. If you just Google Guy, he's everywhere. And I raised my first $1 million from him. So he was the lead, and that opened the door with a lot of other VCs. So pick your lead very carefully, because the rest will come quickly. Count on 6 to 9 months, plus 3 months of due diligence. I tell every entrepreneur, you've got to have good founders, because you will not be running your company during this phase. You will be a full-time fundraiser. It's just the way it works. I mean, if you're going for big venture capital, if you're going for a couple $100,000 seed money, it's a different story. But once you get into the VC, you're a full-time fundraiser. You're on the road all the time. You're raising money. You have to, and someone's got to be running the company. Someone's got to be building the company. So that's why the team is so important. And it takes 6 to 9 months, really, 6 months to get a term sheet. Typically, when you start, you'll dicker back and forth with a couple of different ones for another 2 or 3 months, and then you go into a due diligence period. So raising money is time-consuming. And there's no, I don't know of any angel group that'll write a check in 30 days. I don't know of any VC has ever written a check in 30 days. Right? It takes time, so you just have to plan for that, as part of your business. I always say don't raise, socialize. So I learned this later in later ventures. Early on, I was always out raising, and that's okay. But if you socialize your company and your opportunity with angels, with VCs, without asking for money, you'll go a lot further. So what will happen is you'll get an intro, you'll go in and see a VC, and there's a whole bunch of them here in Florida, and there's more of them starting to set up because of Magic Leap and other opportunities. And you just say, I'm not raising. You are raising. They know you're raising. But you say, I'm not raising. I want to socialize my opportunity, get some feedback from you about what I can expect. And when we are ready, I think you might want to be one of the first to look at our deal. That works wonders, because you're not knocking on door, hat in hand, please give me money, please give me money. You're socializing your deal. You can do it at conferences. You can go to the Florida Venture Forum. You can go to SupX. You can go to Emerge Americas. There's all kinds of different places you can go and socialize your deal, and you'll get great feedback, and they'll do it. It's in a non-offensive way, so the VCs don't feel like they have to tell you no or your idea is stupid, because you're socializing your idea. You're not there hat in hand trying to raise money, and you'll find out really quickly when to turn the trigger to start raising. Just giving you a great tip. Learn lessons learned the hard way. And then, of course, last is don't be piggy. What I mean by that is don't have unrealistic expectations for how much money you need and what percentage of your company you're willing to give up for that, because your chances of being successful are always better with the money than without, even if you have a lower percentage. All right, Q&A. I think that was it. Want to go to the next slide? There we go. There's my email and my LinkedIn if you want to link me in.
Yeah, we have invented a new product, and repeating all those questions you're asking, we can go through it, because we have done all those things.
Good.
Now we are looking for funding for 6 months. We're looking for $1.5 million.
Okay.
And
So the question, he's looking for $1.5 million. He's done all of that stuff. And the question is?
still, as you said, I'm still shopping around. I'm talking to many people, still haven't get the answer.
Okay. Well, you're doing something wrong then. So let's talk offline. If you have all of those things,
Yes.
right, and you're only needing $1.5 million, and you've been talking, and you're not getting any term sheets, you're doing something wrong.
Just a clarification, I think early on you said, early on, don't worry about valuation because we're going to be doing convertible notes. Can you elaborate on that? How would you invest on something without valuation?
Yeah, so convertible notes are very popular, and there's two types. There's convertible debt, and there's a safe. Safes are very popular on the West Coast. Investors on the East Coast hate them, which is too bad because we're a little bit behind the times. So, but a note is an opportunity for an investor to invest without arguing about valuation, and they're going to convert at whatever the valuation is on the next round at a discount. So I'm going to write a $100,000 check, and I'm not going to argue about valuation. I am going to get a secured position, secured by the IP of the company, the revenue, whatever. So I'm a debt holder. I write you a $100,000 check. A year later, 2 years later, you do your round. I get to convert that $100,000 into stock at whatever the valuation is, plus 20%. I get a discount. I'm using 20. Some people will go 30, right? But that's the whole concept, is you're not having to argue about valuation.
Now, you also mentioned that the owner always has a very high expectation in terms of valuation and so forth. How do you reconcile that a year later? Does the owner have any say on the valuation, or is that pretty much up to the investor?
If the entrepreneur is smart, he or she will let the lead investor set the valuation. Don't ever go out as an entrepreneur, this is another tip, and say, I'm raising $1 million at a $10 million valuation. Don't ever say what your valuation is. Just say, in order for us to execute on our plan, and look at this plan, it's awesome. We're going to own this market. It's a great product. It's a great technology. I need $1 million. And the investor's going to say, what do you think for that? You tell me, you're the expert. You tell me what you think my valuation is. Never, as an entrepreneur, offer an evaluation of your company if you're smart. Unless you're unless you're in Series C or Series D, those valuations are set. They're usually 3 times what the last value, 3 to 5 times what the last valuation. Once you get that far into it, I've been there, those valuations are set, right? But early on, let the lead investor set it, or do notes.
So what are your thoughts on crowdfunding?
Yeah, I love crowdfunding, and the problem with it now is that everybody thinks they can raise money through crowdfunding, and unless you have a marketing plan and you can create buzz among your friends and family to get some momentum going, it will die soon. I just was working with a group here that has an awesome product, but it just was staged wrong. But and by the way, you can do crowdfunding compatible with going and doing a raise, and especially if it's doing well, because that will serve as a barometer for the angels or the VCs on how well people are like your product.
Yeah, to follow up on that question, so how has what has the trend you've been seeing in crowdfunding been driving some of the venture capitalists and some of the angels? What are they looking for when they see something on a crowdfunding? What are the key things?
They're looking for exponential traction.
So they're looking for continued growth,
Yeah.
continued funding.
Yeah, and when they want to throw fuel on it.
Gotcha.
They want to come in with the gasoline. And sometimes you can, if you do a great crowdfunding, that is your seed. You can skip seed and go right to Series A.
Yeah, that's kind of where I was curious where it was going with that. If you got enough seed, then you're going right into the major capital and so forth.
Right.
Later. Okay.
You can skip all of that if you have a great crowdfunding campaign.
Thank you.
So related to the seed, say a convertible note or a safe note, are you seeing many of them then without caps? No caps on these safes or convertible notes?
That's a great question, but they all have caps.
So wouldn't that be the valuation? Isn't that the negotiating point?
It's an artificial valuation, but caps are usually set artificially high for that reason. So that's a whole I could talk about caps. The point's well made. Usually when you do a note, it says it's going to convert, but you're not going to pay any more than X at the next round. So it's an artificial valuation. It's not a real valuation. The question is it a reasonable cap, right? And by the way, if you want to understand how this whole game is played, get Venture Deals by Brad Feld. It's the best book ever written on how venture deals are structured and how you do these safe notes, convertible notes, all of these series. But it has a big chapter on caps.
Thanks. I actually read that book.
Isn't that a great book?
It's really good. Also, family offices. How do you find family offices? And then when you're speaking to them, is it usually the family you're negotiating or pitching to, or is it usually an agent, outside agent?
Yeah, it's their investment advisement team. A great place to find them is at the Family Office Annual Conference. They all show up. And all the investment advisors for all the family offices are all in one place every year. I think it's Richard Wilson, is it? It runs was in Miami, yeah. So they actually have a conference that you can go to, and all the investment advisors will be there. But you can.
Where's the conference?
It's an annual family advisory conference. I don't know exactly the exact name of it, but you can Google them. You can find out. You can get a list of the family offices in the state of Florida. There's a lot of them. A lot of them in Palm Beach, Boca, Fisher Island. Any other questions? I'm a little over my time. I really apologize, but I flew through it because I wanted to give you guys a lot of information, but I'm giving you the opportunity to. Oh, is she saying 10? Like done? Okay.
Which of the investment platforms have you found the best recruiting on?
Recruiting when I'm recruiting a deal, or when I'm as an investor.
Well, actually both. Yeah, as an investor and for the founding team.
So I think the founders find more success on AngelList, but as an investor, I prefer Gust. So it depends upon what side of the table you're on. But I think most founders will say they had more luck on AngelList. You're all smart now. You're all venture capital experts.
What's the typical life cycle of the idea stage to, in a very broad, but from the initial seed to the investor pulling out and saying, okay, it's going public? What's that time frame that the entrepreneur could say, I'm going to be public in 3, 5, 7 years?
Yeah, and so it's different at different stages. So angel investors look at a 3-year horizon to be out in 3 years, and sometimes it's the VCs coming and taking them out. Venture capitalists look to be out in 7 years, within 7. Or as I say, you could become an overnight success in 20 years. It takes a lot longer than you think. Any other questions? All right. You're all smart on how to raise money. Thank you very much. Pleasure.